there, it's Sergio. It's Thursday, May 19th, and I'm bringing you a self-storage investor and market update. Whether you're an investor with us or not, my hope and expectation is to bring you some insights and commentary on what we're seeing in the markets and how we're reacting to all the headlines and economic activity as it relates to self-storage. A few weeks ago, a few folks on our team attended the Inside Self-Storage conference out in Vegas. Our goal there was to be plugged into the self-storage community as it relates to education, but more importantly, to understand the markets and understand anything that related to changes or adjustments we need to make in our strategy. So here's an update for you. At the conclusion of this, we're going to link to a survey that we'd love for you to participate in. We want to take what we're learning, hear from what you're seeing out there, and then be able to give a readout to give a broader market review of our individual experiences and what we're seeing instead of just relying on talking heads and data points. So I'm going to talk a little bit about general major market themes, self-storage update, and then roll into acquisition strategies and what we're doing at Hearthfire Capital to adjust our expectations going forward. Let me start by saying the turbulent times and prospects of a market downturn and recession is exactly why we got into self-storage years ago. As we promote on every one of our videos and anything that we do, self-storage is known as recession resistant for a reason. Go back to the Great Recession, self-storage was the only industry that had a positive return. So whether the market's going well or bad, up, down, self-storage is there. There's no difference now. This is the market that we are in. It's turbulent. We have very high inflation. You only need to go to the gas pump, go to the grocery store, do any kind of shopping to see the impact that's having on everyday real income. We'll talk a little bit about what we expect that to mean as it relates to self-storage and as it relates to the market in general. Market volatility, the market's crazy. You're seeing the S&P, Dow Jones up big numbers, down big numbers on a regular basis, mostly on the downside. For the year, again, being in equities isn't fun. We have rising interest rates. The Fed has talked about raising interest rates over the next several meetings. My expectation is that they're going to increase interest rates to the point where the market's coming to a standstill. We're already seeing signs of that in real estate and in housing. So the expectation there is that they'll keep raising rates for probably the next two meetings before everything comes to a grinding halt. The interesting thing to watch here is stagflation. That's where it's stagnant economy and inflation running off the rails. Not sure what my old friends at the Fed were thinking with funneling so much money into the economy over the days of COVID and even beyond now. So that has come home to roost there, and now we're paying the price. There is a potential for a recession. We had a negative print on last GDP numbers. There's talks that was just simply related to trade imbalances. Whatever the case may be, read the headlines. There's lots more talk of recession on the horizon right now. So it's in our best interest to keep an eye on that. There's a big rush to sell real estate in every industry, every asset class rather, whether it be multifamily, self-storage. We are in fact selling our first self-storage facility that we acquired back in 2019 for that reason, capitalizing on the last hurrah as it relates to big prices in a seller's market. We expect that to change. So, relative to expectations, we are expecting that the market is going to solidify a little bit. We'll have a little bit of slowdown as it relates to sales. Properties that are coming to market will eventually be fleshed out. We'll see the higher interest rates. We'll see that slow down. There might be some really good opportunities to acquire with price adjustments over the next few months. Was basically a prediction or thoughts from some of the leading brokers that we talked to at the conference. Year to date, from a self-storage performance, things are really going well. Net rentals year to date is very strong. Rent increases are easily being absorbed. We are seeing the pace of increases to slow down and moderate, likely more towards not necessarily a normal, I would say 3 to 4% increase, but with real incomes dropping, customers are only going to be able to absorb so much. So we're keeping a really close eye. We're pushing as aggressive as possible with those rates, but also being mindful that we need to be making sure that our occupancy is where it needs to be. As it relates to our acquisition strategy, what we are doing right now is we are underwriting with higher interest rates, lower loan to values. We expect the lenders to tighten the belts a little bit, be more selective on what they're loaning on. Again, we mentioned lower pace of rent increases. We're incorporating that into our underwriting. Higher exit cap rates. We've been underwriting to 5.5%. We're likely going to be 6 to 7% going forward. We do expect the demand for self-storage to be there, if not increase. Self-storage is fantastic during down markets. That's not expected to change. We're also doing risks analysis and sensitivity analysis as it relates to a potential recession. What that means is we're looking at markets, we're looking at the employment industries that are out there, employer diversity in the markets that we're in, population density, trends in migration. Positive migrations continue to take advantage of what we've been seeing with COVID over the last couple of years. We don't expect that trend to change. In fact, those folks that moved outside the city, we're not expecting them to move back into the city, especially if there's a market downturn. And we're focusing on median income. We want those median income numbers to be at least $50,000 to $60,000 a year plus. So we're going to increase some of our expectations there. We're continuing to pursue properties in secondary and tertiary markets, especially where the supply demand numbers are exceeding even what we would normally look for. We're being more selective. We are maintaining open communication with brokers, keeping a tight pulse on the properties that are coming to market, looking for lower risk value add opportunities, and continuing down the path of looking for those expansion potential acquisitions. We've been building a really strong construction management and expansion team that is full bore with the CREEP project and those properties that we acquired over recent years. So we're really strong in that regard. We plan to continue down that path. In fact, one of the things that we are exploring is ground up development. There are plenty of markets, especially in the markets that we're in, the secondary and tertiary markets, where there are some opportunities for acquiring some land and where we're able to get a price per square foot that exceeds or is better than the replacement value when we're buying something that's already built. So we're really looking at that hard. We think we can get some really strong, C of O, get the equity built into our deals from that standpoint, and we'll be able to accelerate what we're doing. That's even considering supply chain and cost of materials. We expect that as demand wanes in the industry, interest rates and everything go up, that the supply side pricing on materials is going to come back down to normal. Of course, with everything going on in the world, anything can change on a whim, but we're keeping a strong pulse on that. Self-storage is not like other asset classes. We're talking about concrete and sheet metal for the most part. So the supply chain issues are not really that big of an impact for us. Pricing a little bit, yes, but we're keeping an eye on that. Some new opportunities. At the Self-Storage Association conference, the big theme there was RV and boat storage. The reason being that even prior to COVID, and we know this because we're in the industry, the RV and boat markets have really exploded. They were hot before COVID and have taken off even more so post-COVID. There are millions upon millions of units being delivered and out there on the road. These are not vehicles that can be stored in people's driveways. So there's a big, huge demand for RV and boat storage, and that we're finding that the opportunities are in areas where as little as 3 acres, but 5 acres plus of land in an area that it's in between homes, recreational areas. There's some significant opportunities there. There are some folks in the industry that are reluctant to go into that space because there's a lack of industry data. We're seeing that improved, whether it be through Yardi, but also just looking at the numbers from deliveries of RVs. So that's an area that we see as an opportunity, not necessarily a risk. So look for some potential opportunities in that space. Again, relative to the survey, let us know if that's in a space or an asset class that you'd be interested in. We're going to be pushing forward to look at that as well. We're looking at, again, I mentioned the new construction, continue down the path of expansion projects, especially in those markets that can easily absorb the demand, even if they're especially if they're well positioned for a market downturn. We're also looking at JV opportunities. Our platform and our network is bringing a lot of self-storage industry experts or folks that have access to some properties, some deals, maybe not be able to execute. So we're looking to bring that to our investors, partner with the right folks, and bring some better deals, some strong deals. Just to give you an idea relative to expectations on returns, with the higher interest rates and higher cap rates, the return numbers are not going to be what we've been projecting. If you missed the boat on some of these recent deals, we're still targeting properties that are 12% plus IRR, but the days of approaching 20 are likely over. This is actually a big theme that we heard from several of the big brokers. The expectations on returns need to be adjusted. Just concluding with this, the asset class self-storage is rock solid, right? So in multifamily, as real household incomes decrease and the pace of rents increase, you can expect that there's going to be some potential for regulation and some infusion of municipal interference to put a damper on that. Self-storage was considered an essential service during COVID. We're subject to lien laws. So we don't have the same level of risk that I see relative to other asset classes. So all that to say is we're still very bullish on self-storage. While we expect the environment of the interest rates, inflation to be reverberate, across the board, in our space, we still believe the asset class is going to outperform all others going forward. And again, love to hear your feedback. Hopefully you found this update of value. Let us know, send an email back to us. Just let us know what your thoughts, let us know what you're seeing. If you're actually in the real estate industry yourself, what are you seeing, whether it be residential, builders, commercial, what have you. Love to aggregate this. We consume a lot of content, a lot of headlines, try to parse through it, both in terms of data and what we're actually seeing. So look forward to bringing some great new investment opportunities. Join our priority access list if you're not already. Have a great day. Thank you. We'll talk soon.